Tesla shares sliding more than 7% after missing on the top and bottom line yesterday. Elon Musk shared his concerns about high rates hitting the consumer, and it was music to the ears of our next guest, who says it broadly supports his bear thesis. Joining us now is Jewsikow, a Guggenheim Securities expert. He's got a sell on Tesla and a price target of more than $100 below the street average. John, welcome. Good to have you with us. It sounded not only was Elon Musk concerned about interest rates and that, but he was very concerned about affordability of his cars and losing market share as a result of their priciness.
Yeah, no, it's a very real problem globally. I think if you think about interest rates and the price point of Tesla vehicles, the average payment on a Tesla vehicle right now is north of $800 a month on a Model Y. And the percentage of U.S. households that can afford a payment like that, there was a good study by Cox Automotive that suggests it's something in the 10 to 15% of U.S. households actually have enough income to afford that. And that's just based on the ability to afford a monthly payment, let alone the actual cash balances and things like that.
Yeah, and I agree. The idea, I think more people buy the payment than buy the price of the car. Of course, the two are inextricably linked. However, so he's in this box. How does he get out of it?
Well, I think the business is actually doing quite well for a cyclical automotive business where it is. It's really the valuation of the company that's kind of disconnected from the product they sell. Coming into the print, there were kind of three tenets to the bull thesis at Tesla. The first one was pricing and margin stabilization. I don't think we got that this quarter. I think it's pretty clear that the direction for pricing and margins remains negative. The product cycle, people were bullish ahead of the Cybertruck and the Model 3 refresh. The Cybertruck discussion on the conference call was pretty sobering. I think they largely indicated that it would be a dilutive product, at least for the next 18 months. And the Model 3 refresh, we've highlighted to clients that it's not a perfect metric, but customer deposits fell quite a bit quarter over quarter. We would have expected that to increase if they were building backlog of product. And then full self-driving, we didn't get the tangible updates that bulls were looking for related to FSD licensing and really kind of these longer term bull narratives.
So strike one, strike two, strike three here.
Exactly. I think that's a fair characterization.
Ron, your price target is $125. Do we know what proportion of Tesla shares are retail versus institutional ownership here, in the sense that this often has been a cult stock where it's more about the personality of Musk and it reminds me of crypto a little bit, who's got diamond hands and who doesn't here?
Yeah, we don't know the split. We do know that on any given day and the average day, Tesla is the #1 traded retail stock by an order of magnitude of 4 to 5 times. But in terms of the actual ownership, Tesla's float turns over far more than the average stock. So it's really difficult to know.
Right. I guess my question would be, how much of the share price is fundamental and how much reflects, just enthusiasm about everything that Musk himself has achieved or what Tesla may achieve over the next 5 or 10 years? In other words, does that depend on different factors than just, kind of going through the balance sheet?
Yeah, it's a great question. I think our price target, 125, has a very good handle on the auto, the energy, and even full self-driving as it currently exists, and charging as well. What we don't give credit for, because we think it's far too difficult to have confidence in, is things like robotaxis, humanoid robots, things like that. So whether that's retail or something else, we think there is about $100 of kind of not currently existing businesses getting credit for Tesla. And
how big?
You can call it the Elon premium. That's fair. I think he's earned the right to have it be called the Elon premium. I think that's fair.
How big a contributor eventually to revenue might the fact that so many other manufacturers are now adapting to the Tesla standard charger and then to their ability to build out the charging networks that are going to be needed, presuming people buy into electric cars. How much is that going to help?
Yeah, we have the charging business at Tesla, including all of the NACS partnerships, worth about $10 per share. That basis for that is a 2035 scenario based on the global EV car park, but primarily U.S., where they've become the standard. We think it can add about 50 cents a share to earnings in 2035. So not insignificant, but not.
But that's a long way away, man.
Well, yeah, you think the amount of new vehicle purchases that are electric vehicles are still in the high single digits in the U.S. They're about 7 to 8%. It takes a long time for the percentage of the total car population to become electric vehicles.
Yeah.
So that's why we went out to 2035.
Yeah, no. And all right, so 50 cents in 2035, that's what, probably equal to about a nickel now. I don't know.